So welcome back, everyone. My name is Maria Smith. I am the Chief Impact Officer at BII. Good to see familiar faces in the room. I'm looking forward to this discussion today. I mean, you know, as a DFI, investing in productive and sustainable businesses is very fundamental to our investment mandate. And over the decades, we've been trying to do this in a variety of ways. I mean, you'll be hearing from a lot of our investees today. You know, these are platforms that we have set up to try to introduce flexible capital to SMEs. We've been working with fintechs who are using technology to try to address some of the market barriers. We've even been working with traditional banks to think about how we can risk share and get them to look at longer tenors and flexible products. And every time we're doing this, you know, we're trying to think about how we can address the biggest gaps in the market, the biggest segment gaps in the market, but also how we can do this in a scaled way, in a scaled approach. So we've got lots of lessons learned from the decades, and I'm very pleased to have a panel of guests here that are sort of in the trenches doing it themselves. Versus me doing the disservice of sort of introducing you all, I think what I'll do is ask you to say a few words about yourselves and the businesses that you're with. Maybe starting with you, Nikolay.
Thank you very much, Maria. So my name is Nikolay Angelov. I'm part of the SME Finance and Development team at the European Bank for Reconstruction and Development. We do quite a lot of different things, and I guess we'll come to that later in the panel, but essentially in my case, I'm involved with two main activities. One is I happen to be responsible for a fund that provides flexible financing, to use the terminology of the event, to companies in the Western Balkans. I know it's not Africa, but it's still relevant in some ways. And the other thing that I'm responsible for is a program that we do for startups in all sorts of countries. It's called Star Venture, and it provides support to startups and accelerators with the idea to build the ecosystem.
Thank you. And Benedicta?
Thanks, Maria. I'm Benedicta Wontumi. I'm the head of credit risk for Growth Investment Partners, which is a BII subsidiary in Ghana, which was set up to provide flexible financing to the SME to help them scale up their businesses. My background has been commercial banking. I'm one of the credit approvers who have given very tight structures to the SMEs. And then in the past 2 years, in 2023, I moved to GIP. So I come in with a debt knowledge and with from the SME perspective.
Please, Barthout.
Yeah, Barthout from Slingelandt. I'm a partner at XSML Capital. We are a fund manager investing in frontier markets, as we call them, in sub-Saharan Africa, specifically Angola, DRC, Uganda. We just opened in Zambia, and we have a small team in Kenya. We provide tickets of between 300,000 up to $10 million in cross-sector, so we don't have an industry focus. And we do that through mostly credit. So in all our companies, we put debt in. In some cases, it's with revenue share, so that's one of the things that on flexible ways of getting your returns back, that's one of the things we do. And then in specific cases, we take equity stakes, minority stakes, but always in combination with debt. And I can talk a little bit later about why we do it that way. We have teams in each of these markets. We're in total now about 25 people. We started in 2010 with a $19 million fund, which I don't think you would see these days anymore because it's really subscale. We invested 60 million of that. We have now invested about 160 million. We raised at the moment around 260 million, and we returned about 60 million back from the funds that started in 2010. We're in our fourth fund now. Last vintage was this year, early this year.
So maybe I can start by sort of underscoring one of the points you made, which is, you know, providing this capital, the ticket sizes that you're looking at, and the types, this combination of equity and debt, which is quite different from what banks would offer. Yep. So can we get into a little bit more detail about how the products you are offering is different from what traditional financing sources would offer, and maybe a little bit how you got to those types of products?
Yeah. Yeah. So I think, things have come up this morning also on different segments of the market and what are the products being offered there. What we see still in our markets is that banks haven't really changed their approach. So they're still very much, and that's also driven by regulators and balance sheets that they need to manage. But we see typically no grace on interest or principal. Rescheduling is very difficult. Collateral, we do take collateral in all our investments, and it works. Unlike what was told before, is we can get our money back if we have a mortgage in a country where you would think you can't. But banks typically say, well, for a loan of, let's say, 200,000 or 300,000, you want at least collateral of about 600 or 700,000. That hasn't, we saw that 10, 12 years ago, that hasn't really shifted. And if you ask me very honestly, I would say we shouldn't be there, because it's really the banks that should be doing these type of things more than they do. But because they don't do it, there's room for us to prepare companies that are smaller, then they build their business, they get more collateral, and then banks can also participate. And on the larger ticket size, we often work together with banks to do funding.
Okay, so you're taking the collateral, but at smaller amounts or different types than the banks would.
Yeah, I think our coverage is around 95% over a portfolio, but it's not the 200% that a bank would require. And then I think another main difference is the flexibility, which is one of the things that came up as well this morning, is that we often provide a grace on interest principal, sometimes both at the beginning for 3-6 months, because it's capex, so it's an investment that needs to be made. Companies in these markets need time to import the equipment, therefore they can't really make money with them. So it takes them 6 to 9 months to do that. That's the room we provide. And then COVID came up also earlier, like I think most of the debt providers. That was a period where we also rescheduled. And in the meantime, if there's other reasons, we're in quite close contact with our promoters. If there are good reasons, then we would say, okay, we reschedule for 3-6 months because you don't have enough headroom to run the business. But we look at really at what the cash flows are and what the reasons are to ask for that.
Yeah. Benedicta, I mean, similarly, GIP is looking to sort of bank these businesses that wouldn't necessarily get traditional financing. GIP is in the earlier stage of business, but that means you have sort of, I guess, fresh market intelligence and fresh mapping as to what the need is. Can you describe it?
So we have 3 different products. We have the Flexi product, which is what a bank would normally give as a term loan. But how we differentiate ourselves, because we find out that the banks are restricted in how they structure the repayment to meet the needs of the customer. So normally it would be a monthly repayment. Some banks are not too comfortable with sort of a ballooning repayment. So with GIP, we structure our cash flows. We structure the repayment to suit the cash flows. So if the cash flows is due to come quarterly, the repayment will be quarterly. Just like he said, we also give moratorium. In terms of collateral, we are not too strict. We give for the Flexi product, we can take up to 70% collateral, and our loan tenors are longer than what the banks would do. In addition, we provide business support. So we work with Ghana Invest Support Program, which was set up by BII in Ghana. If we have SMEs that are not investment ready, but it's a company that we would like to invest in. So like we have one which is a woman's-led company, which we're very interested in, but they weren't investment ready and they didn't meet our criteria in terms of turnover, the number of staff. So we got Ghana Investment Support Program to work with them to make them investment ready for us to be able to fund them. So that is for the Flexi. So the Flexi is closer to a term loan that you do for banks, but the flexibility comes in the cash flow structure and the tenor and the moratorium that you have, and the fact that we don't ask for too much collateral, because normally, typically, banks will ask for a lot more collateral to mitigate against the risk. Then we have a royalty product. The royalty is just like the Flexi, but the difference is, apart from the interest that we're charging, we charge a percentage on the turnover. So it's like a So the good thing about it is because of the percentage of revenue that we charge, the interest is a bit lower than we would, for the Flexi. And then we have the mezzanine, which we haven't done a lot of. Now with the royalty, coming from the banking sector and where one of my colleagues spoke about, one of the major risks you face with SME is diversion of funds. This is due to governance.
Yep.
This is due to, I mean, having enough, or is it financial literacy from the SME? So for us, what we do with the royalty, apart from the business support, we ask for a seat on the board or observer rights on the board so that we have a part, we are part of the governance. If we find that there are issues with financial literacy or they need to get stronger accountant base or someone who will manage their accounts, a stronger financial controller or something, we put it in as a condition and we help them find the right people. So this way we support the business to get to the position that we want them to be. ESG, when it comes to ESG, we draw an impact plan with them to support them to make sure that they are compliant for the time we are doing the transaction and in the future. And if there are issues like 2X, we can help them. So for a recent deal that we did, we got a board, we got a woman because they weren't 2X compliant. So we got a woman to sit on the board. And in the same business, we knew they needed someone with a strong legal background. So we got a lawyer who was a woman to sit on the board. So these are the things that we do that are different from the banks. We have been talking to the banks to collaborate with them, you know, so they can do short end, we can do long end. And then this is a way to get the pipeline, and to also to be able to support the SME business better, so they don't have to leave the banking sector, but they can be able to access funding through us.
Yeah, there's definitely a theme with both around this, the idea of a graduation program, isn't it? And I guess if things move in the right direction, there isn't a need for either of these business models if the banks were to move. But in the meantime, at least you can provide this pipeline for them for future business. Nikolay, I'm actually very interested myself to understand, because EBRD is very unique in that you're actually lending directly to SMEs. So most DFIs, like us, we lend through financial intermediaries, including more innovative models like GIP, but through banks, because accessing the SMEs directly is challenging. So I'm very interested to hear how you are providing this flexible capital directly to the businesses.
Yes, it's a very good question. So clearly, EBRD has a slightly different mandate. At the time when it was created, it was mostly to help the transition of the countries that were in the former communist bloc and essentially Southeastern Europe and the former Soviet Union. Now, the mandate has changed a little bit because we have expanded quite a lot, but the way we tackle the SME part of our activities is pretty much the same. And we have two main strands. One is we have very strong local presence. So in our offices in each country where we operate, and now there are, I think, 37 countries, soon to become 42 or 3, with the expansion to Sub-Saharan Africa. And in each of these countries, we tend to have enough people to do the local work. And in our case, when it comes to SME outreach, we have an advisory program where essentially local staff goes around, identifies suitable SMEs, and then we provide them with advice. Essentially, what we do is match them with consultants, either local or international. We make sure we administer the program in a way that delivers impact. We also cover some of the costs using donor funding mostly. So this advisory program, which is present pretty much in all countries except in those in Central Europe, which are very much advanced and maybe they don't need this kind of assistance. So that program allows us to have a proper sense of what's happening in the local SME sectors. And then occasionally, when we find a good company, we can proceed to financing it. And the advisory program gives us also the chance to build up the company to the level that is required to meet our requirements. Why? Because EBRD is a DFI, we cannot do things like local banks for good or for bad, so it kind of makes us less flexible, but it also means that whenever we endorse a company by financing it, we essentially give a very strong signal to the market that this company is really up to the required standard. Now, when it comes to financing SMEs, we do it also a bit by necessity. Why? Because in about half of the countries where we operate, the markets are small, so the countries have maybe less than 10 million population, so big projects and big companies are rare. So if you want to be relevant and to systematically deliver impact, you have to go local. And so what we try to do is to find the local champions or companies that have the potential to become champions, and then we support them with finance, which could be flexible, could be a loan, could be equity, could be anything in between. And then we also provide quite a lot of technical assistance, again, through this advisory program that we have, which allows us to build up the company pre-investment and also to support the value creation post-investment. And again, this is not very different from what you guys do, but we do it a bit more in the confines of EBRD as a whole. building upon the whole expertise that the bank has in all sorts of activities, not only on the financing side, but also ESG and anything else that is relevant. And we also do a bit of policy dialogue every now and then. It's not a systematic activity because policy dialogue is not just focused on SMEs, it's focused on all sorts of institutional development or building the legislation, and that has repercussions beyond the SME domain. But essentially, if you want to have impact, you have to tackle all those three.
Yeah. And given, you are EBRD, I imagine you're tracking different impact indicators. I mean, I'm curious as to, is part of what success looks like here this graduation story we've just been talking about? Do you look at, how they can access, these businesses can access funding from other sources?
We do, yeah, especially on the advisory side. So anytime we do an intervention, we then go 12 months later to the company and check certain indicators, like how much they have grown in terms of revenues. Have they accessed additional financing from another source, or including from us? Have they done, more exports? Have they done certain other things, depending on the nature of the business? And a lot of these have shown that indeed, once companies get on this track to using advisory support, they become a lot more successful. Now, that may be self-selection, right? So they may be good companies to begin with, and then they do the right things and become even better with the help of our support, but not necessarily only because of that. But we do track those, and we know that indeed companies tend to mature over time. Most of them, of course, not all of them would be successful, but essentially we do track the indicators, and we have a very good sense of what intervention helps more than anything else. And maybe just to add to that, in the last few years, we realized that a lot of the work that we have been doing was not entirely aligned with the kind of tendencies in the market, right? So essentially on the ESG front, we weren't doing enough. We weren't doing enough on the digitalization front, so we decided to consciously boost our efforts in these areas. And now about, I think, 90% of the advisory projects that we do have at least one of those three as part of the program.
So listening to you all, I'm thinking this is, so impressive. There's, really bespoke processes and systems, unique, flexible products being created, a lot of technical assistance and value add. And it's also sounding like that's a lot of work and a lot of capacity. And so because the topic of this panel is around scalability, I guess the question to all of you is, how do you do such bespoke work that is necessary to to address this segment, but then how do you scale it? And Barthout, I'll probably come to you first because you've been running for almost 15 years now. How do you manage to replicate this in a scalable way?
Yeah, I think we divide just some numbers again. We invest in over 80 companies. On TA, there's more than 150 projects we've done over time, which goes from all the elements that you've been talking about, ESG, finance, flying CFOs, as we call them, ISO certifications, but that's a lot of outsourced work. So there's a separate facility that some of our investors invest in per fund, and then that money is being put to work for these type of things. We focused on systems, and it becomes a bit of a standard story because that's what you do when you scale. We used to do everything on Word and Excel. For the last 8 years, we have a portfolio management system that then helps with, now there's a new system that includes pipeline, which helps to get all that information in one place. Then there's always an issue about the quality, but that's also gradually improving. Impact data that we have been getting for the last 14 years or so. Again, now it's Excel based, but it will go also in that system. Those things help. Then you have on the investment process side, lending or credit is a relatively standard process. Even if you do TA, if we see that a company is doing relatively well and we don't have to chase them too much for getting repayments, etc., then they're going more into, okay, we've done the investment, there may be a follow-on where we need to do some work, but there's regular contact, but it's not like they take an enormous amount of our time. Okay. So when we had the due diligence for the last fund, one of the questions from BII was, how do you manage, what is the ideal portfolio, and with how many people can you manage it? How do you spend your time in these offices? We think it's very feasible. It has proven itself so far, but it is about standard contracts. We don't use very little outside counsel, because they are standard. There's a few flavors that helps. The main element is to be relatively close to your entrepreneurs, because talking about repayment behavior in DRC, there's less liquidity in the market, you need to make more visits. But then it's about where do you sit. We do less in remote areas. We focus really on cities that are big enough to support a good part of our portfolio. And then even with bad traffic, it takes you half an hour or an hour to see an entrepreneur. And if you then have teams of about, on average, 5 people per country, you can cover a fair amount. The other bit is that with debt, it's self-liquidating. So every month there's a payment if everything goes well. Sometimes with these the certain periods when we don't, but in general that works itself down. So our collateral coverage becomes better over time, and we have to spend less on those. So of the exits we've done, which is probably 30 to 40 across those funds, that is because most of them pay back. It takes a bit more time, but then you don't have to spend time on those companies anymore.
Benedicta, I know like GIP is in its earlier days, but as we are, the ambition is to be able to replicate this model in different markets. So are there certain things you're baking in to try to ensure that this, this high-touch business model is something that you can replicate?
Yeah, so we outsource, just like you said, the due diligence process, we outsource part of it. So the financial due diligence, the legal due diligence. ESG, we have a consultant in-house.
Okay.
Technical, we rely on gifts for technical skills, technical partnership. In terms of the observer and the board, we don't sit on the boards, and we don't intend to sit on the boards ourselves.
Okay.
We work with, we try to nominate people to sit to represent GIP on the board. So like he said, a lot of our time is spent being closer to the businesses to be able to spend time to understand their businesses and any challenges that they have. And then we'll rely on technology for where, we can use it to sort of streamline the processes so that we won't need too many hands doing the analysis,
Can we talk a bit about origination? Because you touched on the fact that a lot of the SMEs' financial literacy might not be, a strength, and so going out and finding new business in a way, you think it would be quite easy, and that these are businesses that are in need of cash and can't get it from the banks. However, I think we know in practice it's not so straightforward. Any lessons learned in terms of onboarding clients and the importance of making sure that they're financially literate?
Yeah. So I mentioned the example of the female-owned business.
Yeah.
So where we can work with them to get the information we need, we will do that, and also work with. We have a financial. You remember I said that we outsource it, so we'll get an expert to work with us to get the information we need. Where we need, there is more work to be done, then we rely on gifts to work with them to be able to get the information or bring them to the level that will be comfortable with them. So far for the transactions that we've done, they have been well-established SMEs that have, the basic information that we need. We've been able to get the information that we need to do businesses with them. Where they are not very financially literate, the due diligence process takes a longer time because obviously you have to work harder to get the information you need to be able to make the analysis to see if obviously they have the cash flows to support whatever they're asking for.
Yeah, I think our big learning has been with Fund 1 is that we thought we could get informal entrepreneurs to become more formal. That didn't work out. So we shifted a bit towards slightly larger tickets, entrepreneurs where we don't think it's a promise, but they have a proven track record. They're willing to move with us. We, on the other side, as a hook, we also always ask for personal guarantee. Because that if things don't go well, it doesn't mean that the entrepreneur is a crook, but they may have other priorities, and this is a way to keep them not a good pupil, but at least to keep them focused on our interests as well. I think those are important elements. And I think the other bit is that with ticket sizes, you also see, we talked a lot about microfinance, which is more unsecured this morning. That's not our space. In our first fund, we did tickets up to 500,000 and then up to 1 million. There were more informal entrepreneurs. Now that has, the average ticket is now 2-3 million. Yeah. We still do smaller tickets, also with sometimes there's really good women and female entrepreneurs who need to get started or grow, which you see a bit more on the lower end in general, unfortunately, but that's how the reality in Africa is a bit in our view. And with those companies that are a bit bigger, there's still plenty of work to be done, but at least you know, with that combination of carrots and sticks, you can get people in the right direction.
Yeah. I'm curious, in your movement from smaller to larger ticket sizes, have you seen any changes in repayment behavior?
Yeah, I think one of our ways to become more sustainable and also lower our fees that investors are paying as management fee is that you, in a way, you have a baseline, which is your bread and butter, which is more secured lending with a slightly lower interest rate. And I'm talking US dollars because we don't do local currency. It's all US dollar in these markets, around 11%. And then if it's a revenue share loan, it's typically a slightly smaller company. It may be a bit more volatile. Then we might, we get to 12% plus maybe 1 or 2% on the revenue side. And then you get, in Fund 1, we got to IRRs of about 17-18% on those type of tickets in dollar terms, which is not bad.
Yeah. You make a good point on local versus hard currency. So you're only lending in hard currency. Benedicta?
We're set up to lend in local currency, but Ghana, because of the issues, so we are giving out dollar, but only to companies that generate foreign currency. So there has to be a match.
Yeah. And Nikolay, are you in?
We're not yet active in sub-Saharan Africa.
Yes.
We don't have that kind of currency problem in most of the other markets because they're not so volatile, and it's much easier to do euros or dollars there. Occasionally we can do either unfunded participation, so very often we participate in loans together with local commercial banks, but not on a portfolio basis, just one by one. And maybe I can talk a little bit about that as well, because it's an interesting product that I don't think any other DFIs have. So essentially it's a product where we rely on a commercial bank to originate a loan to a local SME. It could be also a larger company. And we usually take about 50% share in that loan, whereby we either fund our participation. We typically fund when it's in a foreign currency because we have cost of funding advantage. And if it's in local currency, generally we tend to do unfunded participation. So we give them essentially a guarantee for 50% of the loan. And when we do this, we try to add our value by adding those advisory services to the loan, which the commercial bank generally cannot do and certainly cannot pay for it, while we can do it thanks to the donor funding that we raise. And for example, recently we have tried to introduce an outcome-linked loan program under this product, whereby in addition to the loan, we agree with the company a certain set of KPIs on the environmental, social, and governance side. And then if they manage to achieve the targets, we give them a small, basically, reduction in the interest rate, which is a nice way for us to bank on the strengths of the local commercial banks, because they have the distribution network, the access, and we have the ability to add those additional components that enhance the impact of the instrument. So this is kind of our experience. Otherwise, local currency, not so much of a topic that we are, at this moment interested about. I know in Africa, when we go there, it will be very different.
Yes, I understand you're expanding soon.
Yes, so our shareholders have given us the mandate to go into 6 sub-Saharan African countries. Now we are still in the process of going through the administrative formalities, and this is quite a complicated process. But essentially, we plan to start working in 6 countries, which are Kenya, Nigeria, Benin, Cote d'Ivoire, Ghana, and Senegal, around the middle of the next year. What we will do there is still to be defined, so we are still doing our research and defining our strategy, but in many ways, at least as far as SMEs are concerned, we'll be doing pretty much what we do in the other markets. So a lot of advisory, including for startups, as well as we'll try to do some financing for SMEs, whether directly in the beginning, I'm not so sure, because we know the market in Africa is very different to what we are used to. So I think there will be a bit of adjustment in terms of how we perceive the risk and how we identify the good borrowers. But I guess over time, we will gradually come into that space as well.
That's good news for us. We're looking forward to partnering with you in these markets, like we have been in Egypt and others. One more, but I'm going to open it up to questions in a minute. But I do want to open it up or stress a point that you made on impact-linked incentives, because I think this is an important thing that we're seeing across our SME and actually, quite frankly, across our entire portfolio. Are either or both of you incorporating impact-linked incentives with the businesses?
We track impact, but for now, no.
Okay.
We track, and if we feel that they need to do more, we put it as a condition. So I spoke about where 2x we got
more of a stick
as a
than a rebate.
Exactly.
Yeah.
Exactly.
Yeah, for us it's similar.
Yeah.
There's every time you raise a fund, there's additional requirements or focus areas. So we try and implement that. I think in Uganda, a number of these things are slightly. There's a more fertile ground for it. In DRC, a little bit less, but you still go through pushing companies, helping them, and typically we try to take a few examples of portfolio companies where we know there's a willingness, and then we did that with ESG 8-10 years ago, and then you can show others, well, this really helped, and we're basically doing the same for 2X, and for. We're now looking at more detail on living wages, a number of those elements that really need to come to the fore, but you need to do it step by step.
Yeah.
So for every transaction, we have an ESG, there will be an action and a plan in place to make sure that they are able to meet the criteria for the future. If anything has been identified, there's a plan in place for all our portfolio, which will be monitored by, we have an ESG consultant who monitors it periodically.
Great. I think it would be good to open it up to questions. And if not, I can always come up with, well, we won't be short. Good. Please.
Thanks. Chris Isaac, Magdevco, we're a SME agri-lender in Africa. Currency risk, it's a big issue. Have you found any effective hedging solutions? And if not, how does that influence how A, you select investees, and B, you structure investments?
Yeah, in our case, we do everything in US dollar. Our trickiest country, and we can do that in DRC because it's dollarized. In Uganda, it's possible. There is, of course, an indirect FX risk, and then you typically work that out by giving more tenor so a company has more time to repay, and by looking at companies that have access to US dollars in their business, so it's easier for them to pay you back in dollars. In Angola, where the Kwanza has been depreciating significantly, what we do is we take an outside entity that's outside of the country, which quite a few of those companies have, who has access to dollars or euros, and then if you can't get it locally through the auction process with the central bank, then you can get your money elsewhere. In Angola, what you do see, and it's just one example of one market, but what we have seen, that's one of our first learnings there, is that we thought we could do the similar type of tickets with also, 500,000 up to 1 million or a bit more. Those companies typically have more difficult access to auctions from the central bank, so we're shifting with our ticket sizes to companies that have access because they have a better connection with banks. So it's a bit perverse because we're there we can do that, but we should also do smaller tickets. But then you look at returns, protecting your risk, or basically managing your risk, protecting your franchise, and then you end up, at least for the moment, that's what we're doing.
Like I said before, we are CD denominated, but where we do dollar, we have to, the company or the portfolio, the investment company has to be able to generate the foreign currency. So we don't take that
But your funder accepts the currency risk in that case?
I guess.
Yes, we do.
and it's just temporary now. I mean, we're doing the dollars temporary because the interest rates for the CD is quite high. You know, at the moment, anyone who is borrowing for the SME, you're looking at, we start with a reference rate. The reference rate now is 29%. So 29 plus a margin of 3, 4, 5, you can imagine how expensive it is. So for the companies that generate dollars, because we are building a pipeline, we will review it. But once things stabilize, we'll probably go back to the city. Yeah.
Can I just ask, can I follow up on that to say, how does the royalty payment,
Yeah.
does that provide any insurance on currency risk?
Off the top of my head, I don't.
Well, the only answer I would have is that increases your return.
Yeah.
So you have some, because that's at the end, if you then do it against the dollar, if you have a higher return locally, it helps you a bit.
But if I think real exchange rates are not changing much in the long run, then the devaluations are coming from inflation, and inflation's gonna be is gonna come into revenues.
No, yeah. No, I think you're, that's a fair
Not year
point.
to year,
Yeah.
but in
And
steady
can you
state.
reprice in the local market, which is something we see happening, despite that we have less FX risk, but yeah, that's true. Yeah.
Hello, so my name is Armand from ATEX. ATEX is a trading platform, B2B platform powered by Afreximbank that tries to boost African trade. And so we work very closely with SMEs and local institutions in order to boost their trades. And something that we've seen mostly, investment and trades are so intertwined and so related, and that kind of lies with the currency risk, is how do you use the investment to boost trade, even for sectors like agriculture, where the cycle is longer and they will most likely get their return in the local currency. How do you go about this? Is there still some sectors that you would try and tackle in a sense?
We haven't been great with agriculture in the past. We've done a few investments. It was also in the first fund, was more informal. So there were all types of other reasons. In general trade, we see a fair amount of trade between, that's why our focus is on these markets, because with DRC in the middle, you have Angola on the bottom left, and then Uganda on the north side. What you do see, there's an example of a company that they take half fabricates to build suitcases, and in Kampala, and they sell a fair amount across the border to DRC. So indirectly, by funding them, we help them trade across the board, and there's an enormous amount of movement between these two countries at that border. And we see the same with Zambia and the southeastern part of DRC. We see the same between Kinshasa, Bakongo, and Angola, the Luanda side. So there's a number of companies where that's where we fund local companies, then they trade, and that helps them.
I guess I have a follow-up, sorry. And so how do you think the AFCFTA agreement will impact your mandates going forward as trade gets liberated within Africa?
What we've seen is, for example, very concrete in the past is that DRC became part of the East African Union. That has led to two or three banks that have been taken over, larger banks by Kenyan entities, so that's a clear example. We see much more traffic, visits, consultants coming in, people from DRC also traveling to Kenya, businesses trying to work across the board. So yeah, we're very much in favor of that.
And I work on firms, trade, and productivity. So I have two questions. The first one is, you see, like today we saw a lot of the researchers saying that this is flexibility is good for the firms, it increases productivity, it increases growth. And then you hear the practitioners, the financial institutions saying, yes, but our IT systems aren't equipped to deal with that change. The contracting, the legal, the compliance, it's problematic. So I still feel at some level the research and the implementation are not really speaking to each other. So what would you want researched more? And I'm assuming you don't want the researchers to come and start fiddling with your IT systems, because that would be a nightmare for everybody.
The data out.
And the second question is more on TA, because TA is always brought up into these conversations, and there's TA before, TA after. And after makes sense, it's like reducing the risk of lending to these organizations. With TA before, so you mentioned a little bit about the advisory services and how expensive it is. You mentioned a little bit about TA for organizations which aren't necessarily ready for financing. I'm interested in understanding if there, with regards to the TA before, how many of those firms do get converted and brought into the fold? And is there anything else that you can do to signal? Because I think, for example, you mentioned a little bit about having good habits. And being able to show those good habits and a reluctance to lend unless you already are familiar with the borrower. Is there something that can be done before to bring that ease in financial institutions?
So, okay, so granted, we just started, so we've only disbursed 2 transactions. So I don't have much track record on, whether we've been able to transition companies that are not investment ready. But it's just about the governance, how they set up the management know-how. It's about financial literacy, because you need, them to be able to generate sufficient financial information to give us. It's about, for this particular one, the sales hadn't grown to a certain level, and they were helping them in how to position themselves to be able to do more business to grow. So it's all specific on the type of company, what we take out as, is it the challenges or what they need to do to be able to position themselves, where we can be of more service to them, we can fund them, for them to be able to get where they need to be. So it's just specific to the company.
Just following up on that, I liked and I know that's the case in the VC world, what Steve from Novastar was saying is you look at the entrepreneur. Yeah. That's the key person. If they are not worth the money you put in, you don't put it in. So you can try to help people with TA to make them investable. I think I can count, of those 150 projects, maybe we've done 1 or 2, and we don't do it anymore because and it's also, we're more in growth capital, so it's a bit different than when you're starting. So we in a way, it's a bit later stage, but it's still, is the entrepreneur the person that can really pivot? Are they agile enough? Do they have enough grit in difficult situations that they face every day? We're one of their last problems, hopefully. Are they that type of person that can then grow a business? And then you can help them subsequently with assistance, with what they need, because you make a plan together.
I'm happy also to chip in on this one. So for us, essentially, we do about 2,000 advisory projects a year, and we do about 50 finance transactions with SMEs. And they're not overlapping samples because some SMEs that we advise are very small, so we would never really finance them directly, not until they grow up at least. But essentially, we track how many overlaps we have. So first, companies that we have advised at some point becoming banking clients, and the answer to that is about 50%. But then we also track of those 2,000 that we finance, how many get financing from other sources like commercial banks typically, and that's also a very high percentage. Now, you could say maybe they would have been bankable regardless of our advisory intervention. That's a fair point. That we cannot really assess. But there is a higher degree of conversion, and there are other benefits as well. Again, some of that may be self-selection, and I agree with you, if they don't have the predisposition to benefit from advice, there is no point even starting. So I think that's really the key. Finding the companies that are keen to do something with your help, and then helping them as much as you can. And on the other one, on the flexible versus traditional finance, to me, it's really a cultural thing for us. So if I go to my risk management team and say, okay, we can do something non-traditional, they say, but can you not do a senior loan with fixed repayment? And they're right. Why? Because that's the scalable way. That's the simple, straightforward way you can do many of these quickly. But that's not what the market always needs. So if you need to do something flexible, I would say put it in a vehicle like yours and do only that, nothing else. Because then you focus and you know how to do it over time. You develop your systems and you could be efficient and you could scale it. It's not going to be as easily scalable as the more traditional one, but at least you have a chance.
Yeah.
And I would, to add to that, I would think where we would need help is, there were 2 reports published on our impact over a few funds in the past. So then you do your thing, an academic comes in or a team comes in, they look at everything we do, they have their questionnaire, and then they have interviews, and then it's about, okay, let's see what's coming out. What is the impact really of what you do in this particular case? But on pricing, I think it's we're now going through, have we priced things properly? Because we do reschedulings. Are we then getting our hurdle rate plus our management feedback? Because that really should be the minimum. Whereas maybe our team thinks, well, we do 1.2x, 1.3x on this loan or the gross level, but it may not be enough. And that's where the details or the research that was done this morning is partially on going into a lot of data and then finding out what. I would say I'm happy to have someone come in and look with us at this type of data and see how we can tweak that, because then it becomes a two-way street. It helps the researchers, it helps us, and it's on a very practical level too.
Yeah, and on this pricing point, there's a lot of dynamics, right? Because part of it is, you know, there's an element of concessionality that's needed in everything we're talking about here, and you know, risk from you know, the funders, et cetera. But you're also trying to catalyze this towards a sustainable market and graduate to a banking. So what's the right amount of concessionality at which points, and how do you graduate that in a sustainable way? I think there's definitely some need for some research in that element. Alice.
And that actually leads very neatly into my question, which was about this graduation model, because the biggest win is going to be the sustainability in terms of commercial banking in the long term. And there was two prongs, and I think a lot of your answers have referred to it. One was around how do you incentivize that commercial banking alongside, you know, Nikolay, you were talking about a 50% guarantee alongside some of your other products. And how do you measure how the banking system is moving into that space over time? And again, you were talking about who's got a follow-on loan from subsequent to your lending. But it seemed like that's the big win in terms of tracking that and knowing as organisations when you should move back and let commercial banks come in. Clearly, there's a big gap now, and that's not now. But it's how you track that, how you work with that general direction of travel to make sure that the concessionality is right. Yeah.
I can comment on this one actually further. So in many instances, we find cases where there are underserved or unserved segments of the market. I'm not talking Africa here because we're not active there yet, but say women in business, youth in business, green projects, maybe not now, but you know, certainly a few years ago. So to tackle these market gaps, we essentially would create a credit line which is specifically designed to incentivize a partner bank to lend to that segment. And of course, how do you incentivize them? First, you give them some training, right? If they don't know how to do it, you teach them how to do it. You give advisory to the borrowers. Some of them, you cannot service all of them, but certainly those that are more promising and they have the willingness to receive advice, we can offer that advice. You can offer first loss risk cover that essentially covers part of the losses. So if a bank doesn't want to lend to, say, women entrepreneurs because they think the risk is higher, if you give them first loss, they say, okay, there will be higher risk, but the losses are going to be absorbed by this portion that we add to it. And then you indeed track what happens afterwards. Now, I'm not the right person to discuss that. Certainly, I'm not authorized to talk about it. Not that there is anything that we cannot share, but essentially, our first priority is to fill in the market gap. And if that means we do it for longer than we otherwise may want to, we would still do it. Is it sustainable afterwards? That really depends. Some of these sectors become more mainstream because of other things that are happening in the meantime, like renewable energy. Now, you know, anyone would finance renewable energy. That wasn't the case 15 years ago. Other sectors, maybe not so much. So it's not a really easy question to answer, but essentially we have to start somewhere. If you don't do anything, it will never be sustainable to begin with.
We are the same way. I mean, should I say we compete with the banks, but we don't compete with the banks? I mean, our plan is to be there, to be able to provide these products to the SME, because the banks can't the way that we do it. We give flexibility, which the banks can't, because we are able to put in, because I'm from a banking background, but my colleagues in the office are all from private equity. So we put in conditions that make it very difficult for the SME to divert funds. That's something the banks can do. We can ask to have someone sit on the board. There are reports we ask for. There are tighter conditions. We have observer rights, which the banks do not have. So even though we are flexible, we put in controls to protect ourselves. So for the longer, I mean, we hope to remain and provide and probably compete and collaborate with the banks. But I don't think the intention is to transfer everything to the banks. And yeah.
I find I need to be careful how I answer this question. Because one thing I see as a fact is that there's not been much movement in the last 10 years. So it's still 4 or 5 years tenor, maybe 6, that's max. Then it's the collateral part that continues to be what it is. There can be very good reasons why banks are asking it, because you have your local regulatory body. We're an offshore fund based in Mauritius. We have less regulatory things to deal with. So that makes us maybe a bit cheaper because there's less compliance, although there's for us also plenty of compliance. But so there are, I think, elements that are systemic that you can't really change. And then it's about maybe behavior and culture in an organization, which is, we don't hire ex-bankers. We've hired several, then they didn't survive, or didn't survive is not the right word, but we didn't keep on working with them because it's a different mentality. Yeah, and I'm sorry for no, but it's sorry. Maybe I should. Anyway.
No, that's fine.
But it's, at least that was our experience, and because we need to have teams on the ground that are going in, they can do the whole thing, and it's not about maybe if you're a very traditional banker and you have stuff on your desk. Anyway, there are elements of culture that are different. If that is in a large organization, that's how you tend to operate, then probably it's also difficult to change your mindset. I was with Citi for years. It's a different environment than what we do now. So, yeah.
I think, Patty, you've online questions.
Barthout, you could return to when you decide to blend equity or combine, equity with debt. So what leads you to?
At the start, in our first fund, and we then did 10 of a portfolio of 32 companies. We provided that combination in 11 or 12. A few went really well. They paid back for everything else. And a whole range of others, it was like a VC portfolio.
Yeah.
So, and we had very small tickets. This was a fund where we paid $75,000 for a 20% stake in a hospital that had been starting, but it was cheap. So if you then make 10x and the other stakes were also small, you get your money back over the whole equity bit. So we started to be become much more selective. And now there's a few where we either get our money back through dividends, which has helped quite well because these companies, some of them, they generate a fair amount of cash and we didn't pay top bill. And in some cases, we think that over time there's an opportunity to lump hospitals in Uganda, for example, into another fund or combine them and then do a sale. But it's more selective.
So here.
Andy Ritchie from AgriFrontier. Do you utilise any guarantee products to de-risk your funds and investments?
Okay. In Ghana, we've just signed a partnership with a government-owned guarantee scheme called GESAL. So we just signed an agreement with them for the agri-sector to sort of de-risk. They provide 70% guarantee to cover 70% of the exposure. So even though we haven't booked any agri business, we've gone into partnership with them. And that means that from the onset, from the screening, we'll work together with them because they're experts to, do the due diligence and everything. And after that, they provide 70% guarantee to cover 70% of the exposure.
We don't.
Yeah, we actually do as well, and we have multiple sources. Essentially, for Africa in particular, now the EFSD Plus program of the EU is quite an important one. I was in the beginning advising them on how to structure certain elements of it, and essentially it's meant to provide whatever instrument you have a guarantee to boost both the profitability and also to essentially reduce the loss that you may have, and which is likely that you have if you do more risky things. It's a very big program. It doesn't cover just Africa, but I think a lot of the money would go there. The problem, as always, is utilization. Why? Because the Commission has a very strict set of rules. Not only on how you deploy the money in terms of risk, but also in terms of KYC and jurisdictions and tax evasion, and compliance with that is not simple. So I think that's really the big issue, but it's otherwise a great way to really at scale offer this kind of risky instrument.
I'm just conscious of time. One more question, and then I think we'll wrap up.
So this is more for, I guess, EBRD and BII, which is, do you give up on banks in terms of? I'm just curious how you see this, and I know EBRD in particular has done a huge amount in SME financing. So can you? What's your position? You know, do you go in now to deal with it, or you still rely on the banking?
Do you mean just Africa or generally?
No, generally.
No, we really cannot give up on the banks. And why would we? I mean, the banks have become really trusted partners for us because with a lot of them we have worked for many years. It's true that in some markets we have fewer partners and not all of them are to our standards, so we cannot work on the same basis with all of them. I mean, just to give you an example, Southeastern Europe is dominated by banks that are part of West European Group, so it's very easy. You go to Central Asia, they're all local banks, small, not so experienced, more vulnerable because of all sorts of macroeconomic factors. So you have to take a different approach. But make no mistake, local banks are the primary distribution channel if you want to go small and regional, right? Yeah. We can do business with the bigger SMEs, the more kind of proactive and advanced ones, but we cannot reach the nooks and crannies of the ecosystem without support from local banks. And so that would remain a significant pillar of our activities.
Yeah, and I mean, I'll just echo that. We have 25, almost 30% of our balance sheet tied up with financial institutions, and especially we operate in every market in Africa, or we can, and so getting to the harder to reach markets through financial intermediaries is key. We're getting much more focused and innovative about how we work with the banks, so we don't do many general directing lines anymore. What we do is we'll do risk sharing, we'll do guarantees, we'll direct our lending to segments of the market that we think are in need. So that is SMEs, but it also could be gender, it could be climate. So we're getting, I think, more focused on how we work with them, but no, it's still a core part of what we will do. Okay, good. Thank you. I'm sorry. It feels like we could go on, but we have a fun agenda to continue on with. So thank you all. Thank you to our panelists for your participation.